Today is Monday, February 5th, and this is the ADM Investor Services Monday Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADM Investor Services, and Alan Bush, ADMIS's Senior Financial Economist. Steve, let's start with the grain markets this morning. Prices have fallen back from last week's highs. Why is that?
I think it's a couple of things. I think number one is we're seeing a little bit of a change in South American weather with some chances this coming weekend with some rains in Argentina. We also, I think, got to the point where we ran into some farmers selling here in the United States, and we've seen a little quiet action as China is buying U.S. beans. And then I think there's some trade policy concerns, whether it's NAFTA or even China had an anti-dumping rule that they want against U.S. for sorghum exports to China. And then I think that the market's just got a little bit ahead of itself and is pulling back a little bit.
See, where were the weather problems in South America and what's changed?
Well, the problems with it was too dry in Argentina. They've had about 50% of the normal rainfall in the last 3 months. And so whenever you start talking about a rain event, the market gets a little jittery about that. Brazil also might be just a little too wet in some areas. That's slowing the harvest of the beans and planting of their second corn crop. So it's pretty important right now that crops are getting into their yield determining period. So what happens in the next probably 2 or 3 weeks will determine their final yield and production.
The USDA comes out this week with their monthly supply and demand report. What will they say?
Usually February reports are not big as far as market movers. They could lower the world corn crop 2 million tons. They could also possibly lower our soybean export forecast and raise our carryout. And so it's expecting big changes, but the market will react to that as the numbers come out.
Steve, before we turn to some look at the financials, a lot of volatility in the equity markets Thursday, Friday, again this morning. Does the lower U.S. equity and energy trade have an impact on grain futures?
The market perceives the last 2 days that it has. Money flow and things of that nature. So we've backed off from our highs the last couple of days, maybe like 10 cents in beans and a couple cents in corn and wheat. And many people attribute that to the weakness in the U.S. equity and energy markets.
All right, Alan, so stock futures fell hard on Friday with follow-through today. Many analysts are saying that is due to rising interest rates and maybe that the bull market is over. What is your opinion?
Well, my opinion is that the bull market is not over, and with analysts saying that it's the interest rates that have increased that caused the pressure, I think that's only partially true. I believe that a good portion, in fact the majority of the pressure, could be coming from the political turmoil in Washington, and I think we should treat that as any other geopolitical event, just as what we saw with the Brexit and the various financial crises in the Eurozone. So a geopolitical event pressures the stock indices, and each and every time that has been the case since this bull market started in 2009, there has been a recovery to new historical highs. So I believe that that will be the case this time, and before the end of the year we will see some new record highs in the indices.
Alan, the dollar. Last week the U.S. dollar fell to a 3-year low, but it did bounce on Friday and today in light of the better than expected January employment numbers. What is the outlook for the U.S. dollar now?
Well, I believe the dollar is still likely to come under some pressure, even though traditional thinking is that higher rates in the U.S. should support the dollar index. But I think what's happening is other central banks around the world are becoming more hawkish, more aggressive in their attempts to raise interest rates. And I think other central banks will increase rates faster than the U.S., and that is a recipe for a lower dollar index.
Talking interest rates, the 30-year Treasury bond fell on Friday and also today on news that most of the employment numbers were stronger than expected, including the non-farm payrolls, which were up 200,000 when an increase of 177 was expected. What's the outlook for interest rate market futures?
Well, just today we did see a new, almost 3-year low in the bond market. So nothing has changed in my long-term interest rate outlook. Futures are likely to continue to work lower as inflation increases, and not just commodity inflation, but also wage inflation. So any rallies in the credit markets, especially at the long end, the 30-year bonds, should be used as selling opportunities.
Let me ask you this question, Alan. Let's say the market continued to slip, maybe saw another 4 or 5% downward decline here over the next couple of months. What would that do to the expected interest rate rises this year by the Fed?
It would actually cause the Fed possibly to become a little less hawkish, or possibly a little less inclined to raise rates.
Okay. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.